Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everybody. This is Harold Green of Bright Tree Financial Group, and it is time to stop doing what you hate. Hopefully, you folks are having a fantastic day today. I'm doing pretty good. It's just kind of been really busy over the last few weeks. A lot of different things are going on, and we're right in the middle of profit-taking season where we've done extremely well in the portfolios, and now it's kind of time to start taking some profits off the table and rotating that money elsewhere. So it's been a very interesting time that we're in. And one of the key takeaways that I'm learning here is that as an investment advisor or analyst or whatever, in order to win in today's market, you must have some kind of disciplined approach or strategy or whatnot. Otherwise, it's like going to Vegas and throwing money in a slot machine. You're just guessing at what's going to happen next. And we don't get paid to do that. We get paid to take care of people. And I have a very interesting show for today that I want to talk about. And then I've kind of been thinking about this for a while, and I decided to put it to a test because I'm starting to hear more and more things out there that kind of disturb me quite a bit. And the hype around it and people buying into it, and it's becoming like a problem. It's becoming a mental problem. It's becoming really like a psychological issue. And the title of today's show is Humans versus AI. Are you ready? 1, 2, 3, let's get it. Like I'm gonna jump right into it. And with tech stocks flying through the roof, and just the push towards AI, the push towards productivity, it's leaving a lot of people afraid of losing their jobs. A lot of people are losing their jobs. Companies are downsizing because they're finding out that they don't need humans to do certain types of jobs. And if you are a kid right now, or you're a parent and you have kids that you're going to send off and get educated, one of the things I'm going to encourage you to have them do is probably take courses on psychology and then get an in-depth understanding of psychology in our modern day society. Because until you can sit down with a machine and they can understand psychology as a human, I call psychology the God factor in everything, because I believe that God created humans and he created our brains to operate a certain way. Machines can learn some of the stuff, but they don't understand the psychology behind a lot of this stuff, the way humans act, why people do great things in life, why people end up doing heinous things in life. And because today is an investment show, we're going to be talking about investments. Obviously, I have to tell you that all investments do carry risk of loss. There's no guarantees, and past performance is no indicator of future results. And if you're going to invest, you have to understand time horizons, risk tolerance, and then make sure you're investing according to a well-balanced, comprehensive financial plan that incorporates a lot of different things like estate planning, like your life insurance, risk management, just like everything has to be built into that plan. And I don't want you acting on anything that I say in today's show because it's for informational purposes only. So they came out with like Chat GPT 5, and some people are raving about it. Some people are like, it depends on the perspective and what people are trying to use it for. So I went into one of my little AI tools this morning and I said, create me a podcast outline for concentration risk in the stock market. And I'm going to kind of tie all of this in together. But one of the main things you're going to start to hear about in today's stock market is, the market is overvalued. A lot of companies are overvalued. They're running up, and the valuations are stretched, and we're starting to run into these positions, like they call it the Mag 7 or the Mag 6 now, that Tesla's, whatever. And they're saying, you want to diversify away from that. You want to diversify away from that. And the question is why? Why is a psychology question, right? it's why. It's not anything about fundamentals or anything like that. It's, well, they say the valuations are stretched, but the question is why are they stretched, right? What's been going on? And one of the things they tell you is you don't want to be overly concentrated in one or two positions. And my question is why not? Well, historically, you could lose all your money. Yeah, that's true. That's historically. But tell me why that makes sense in today's stock market. Tell me why I don't want to be concentrated in a few positions in today's market and today's landscape. And if you're an average investor and you're just like doing this for yourself and you're listening to these people say this stuff and you act on it, I'm going to tell you and show you what has happened to you. If you've acted on this information, I'm going to tell you what's happened to you over the last 5, 6, 7, 8, 9, 10 years. And it goes back to the active management versus the passive management. And it goes back to the fee thing, the nasty word, fees. I don't want to pay fees. Now, again, we're talking humans like versus AI. But I'm going to try to tie this in, but it sounds like I'm going to be all over the place, and I hope I'm not. But we have to look at a couple of different things. Concentrating your portfolio down at the right time is one of the most magnificent things that you'll ever see in the stock market, but it has to be done at the right time. But first, I'm going to start with some of the things that I had this AI thing create for me, and it kind of talks about the concentration risk in today's stock market, and then basically the dominance of a few large cap companies and the implication. Well, AI is the thing, and it's been a mad push for it. We all know that. And if you're sitting on the sidelines over here waiting on the next shoe to drop because you don't like whatever tariffs or whatever, that, as I told someone the other day, I said, look, I had a client come here he comes out a lot from Hawaii, and we're having a conversation, and I said, I get paid to take the emotion away from the table. I get paid to look at this from a psychological perspective and to make you as much money as I possibly can. I have to understand where everyone is. And so, yeah, a few large companies have been making most of the money. And I look at it as your Michael Jordan situation. Now, did everybody know Jordan was going to be a superstar when he got drafted into the NBA? No, as a matter of fact, it didn't go too well when he first started out, but he caught fire and he won multiple championships. He went and played baseball and came back and still won. That's how good this dude was. But at some point, they had to retire Michael Jordan. And it's the same thing with these high-flying stocks in your portfolios. If you are brave enough to draft them and pay the money for them, someday you're going to have to retire them. And it's kind of like they say, you don't want to put all your eggs in one basket, but basket is Michael Jordan, and he's winning multiple titles. And you got paid as these things went through the roof. And now you got so much money, you can just sit it on the side in a money market fund and collect $30,000 a month in interest. Why not do it? Why not? Because there's a lot of different talk out there, and there's a lot of different things that will persuade you not to do it. I call it like stock market psychological warfare. When these people get on TV and they start saying all this crazy stuff, and to me, I say it's crazy stuff because it doesn't make any sense. And I'm going to give you an example. So we just came out of like some of the highest inflation that's been there in years. And you got the Fed doing what it does. You got the president beating up on the Fed about how they should lower interest rates. And then, it's just a lot into it. So the CNN Fear and Greed Index went all the way down to a 3. And if you follow the CNN Fear and Greed Index, you'll understand what I'm talking about. Back in April, it went down to a 3. Everybody was scared. Everybody was running away. I wouldn't say everybody, but a lot of people were selling their Mag 7 stocks. They were running and hiding because they didn't know NVIDIA was getting beat up. And what was happening was people were just like not understanding the moment of time that we were in. And when the CNN Fear and Greed Index was down to a 3, to me, that was one of the greatest opportunities ever. And so what we did is we loaded up. And I'm going to tell you why we loaded up. And there's a theory that I've been proving and testing. And someday I might write a paper on it. I might publish it in a book. I'm not sure yet, but I've been using it to generate some phenomenal returns for my clients. And I'll tell you what it is in a second. But to me, it made absolute sense to go in and start buying not only the stocks, but the options on top of the stocks when people were driving them down. Just like when the big guys on Wall Street said, stay away from Palantir. It's becoming like a meme stock, and all the little guys are buying it up, and it's going to become like a GameStop. And it's like, wait a minute, either you're being disingenuous here or you're straight up incompetent, which I don't know which one is worse, lying to somebody for benefit or just being straight up incompetent with what you're saying without understanding what time we are in, what the situation is. And we went in and I did a conference with some folks in a particular area. I did an online Zoom with them, like a little seminar, and I just kind of walked through the firm and what we do for a living. And I told them, Wall Street is going to tell you one thing, but you need to understand the psychology of this and do something totally different. And if they would have done what I said, they would have been very happy right now. But I don't know how many of them did what I said to do, and that, just took my advice and did the research on it and made their moves. I don't know, but I know what we were doing. We were buying in. And why do I feel the way I feel about this and this whole thing about concentration risk? Because AI is saying, don't do it. AI is saying, look, you need to diversify your portfolio. You need to have a well-balanced, diversified portfolio. And the question is, why do I need to have a comprehensive, well-balanced portfolio? Why? Not only why, I got to understand the timing and when, but it never tells you when, because it doesn't understand when, because there's too many factors to understand the when. I'm going to tell you what my theory is, and I call it the vested interest theory. And what do I mean by that? I believe that there are forces out there to be that can put their finger on the scales and that can turn something to the positive or it can turn something to the negative. And I'm going to go back to this thing about active management versus passive management, because this is where the concentration risk conversation comes in. If you are passively managing your portfolio, yes, you have to be aware of concentration risk. If you are needing that money 10, 15, 20 years down the road, yes, you have to be aware. But if you're just buying stocks with money that you're never going to need, and you're buying one or two stocks and you're going to hold those stocks until the day you die, you don't really care about concentration risk, because that money, you don't need it. You're going to give it to your kids, whatever it pops off to. Or if it crashes or it pops off, either way, you're going to be okay. But that's when the concentration risk comes in. If you are in a passive portfolio that you're going to need 5, 10, 15 years down the road, that's when this kind of conversation kicks in. But if you're actively managing a portfolio, then concentration risks are reduced because of the activity in the portfolio. You have someone watching it, you have someone trading it. They understand when to get in and when to get out. Yes, we have been heavily concentrated in certain positions, and we are slowly unwinding them now that they are up 2,000%. 2,000% in 9 months is insane. Why? Because I understood the psychology of what was happening back then when they were telling people certain things, when the president got elected, the fear about the tariffs, all these different things that drove people nuts, and it caused a lot of chaos in the market. But going back to the vested interest theory, here's what I believe. I'm going to look at 10 stocks versus one of the hottest performing index funds on the planet. So let's go. Vanguard, VFIAX. Their management fee is 0.04%. That is dirt cheap. That's almost free. And we're going to go back and look at their historical returns, their total return, right? Total, actual return, not average, actual return. 2015, 1.3%. 2016, 11.89. 2017, 21.72. 2018, minus 4.5. 2019, big rebound, 31.41. 2020, 18.35. That's during COVID. 21 is 28.63, good rebound. Next year, 2022, minus 18.14%. 2023, 26.21. 2024, 24.95. Pretty cool. But then when you go back in and you start to look at their returns over a specific period of time, over the last, and this is trailing total return, and they have to publish this information. So last 1 month, 5.8%. Last 3 months, 17.36. Last 6 months, 8.57. Year to date, they're at 11.59. Not bad, right? Not bad. 1 year is 19.54. 3 years, 18.12. 5 years, 16.46. And over 10 years, it's 13.91. Now, what do they hold a lot of? Okay. They hold a lot of Apple. They hold a lot of Microsoft. Okay. And Apple makes up 7% of their portfolio. Microsoft makes up 5.87% of the portfolio. NVIDIA makes up 5.58. Amazon is 3.77. Meta or Facebook, 2.65. And if I go and I compare over the last 3 years, or even let's say the last 5 years, Microsoft has done over the last 5 years, 167%. NVIDIA has done 1,500%, 1,590%. Caterpillar, 222, Deere, 181. Verizon is negative 1.5%. Costco is up 220%. ExxonMobil is up 198. Chevron is up 115%. Apple is up 115%. And Supermicro at one point, they were up as high as like 3,702%. That's a lot. Now, if you were concentrated in these positions, just say you were concentrated in all of them. Let's just say you had a 10 stock portfolio and this is all you had. Depending on the weights, man, and what you put in there, you'd probably be able to retire or darn near close to it. And if you put an option strategy overlay on top of that, that would have been crazy. But if you would have been sitting in the VFIAX because you were afraid of concentration risk, you would have done okay, but you wouldn't have done as well as if you were concentrated in a handful of positions that you actively watched and managed. This is just returns without any options on it. This is just straight up returns of what these stocks actually did. I didn't put Amazon in here, but imagine if you just kind of go out there and look at what they're saying. The Mag 7, the concentration in a handful of stocks. We're in an AI bubble. It's like Y2K all over again. Eventually the bubble is going to pop and everything is going to come crashing down to the ground. Question: what if what they're saying is true, right? What if it's true? What if these things are going to come crashing back down to the ground? Michael Jordan, where is he at right now? My man is retired. Is he still out there getting buckets every night? No, he's retired. And what I'm saying is that at certain points of time in history, it's okay to go in and concentrate if you understand the environment that you're you're in. And my theory of the vested interest concept is this: if the top funds are holding so much of a certain position, I believe it's in their vested interest to make sure that that position is taken care of one way or the other. There will be pressure applied to the right people to help things get to where they need to be. Give you an example. When they were talking about banning NVIDIA chips to China, NVIDIA is in a lot of people's portfolio. They're in a lot of mutual funds. They're in a lot of pension funds. NVIDIA is everywhere. And I believe all of these groups have a vested interest to make sure some kind of deal gets done so that NVIDIA stock can come back to where it needs to come back to, because the target prices on these stocks are already set by the analyst. Okay. You can't keep driving a stock down on bad news and or fear, psychological warfare. It's only going to stay down so long. And then the coiled spring theory and concept kicks in where the stock has been pressed down so long psychologically, it has to rebound. What goes down must eventually come back up, especially if the fundamentals are intact. It's a great company. So why would you not want to, within the proper realm and risk a tolerance, if you're high risk, like myself, why would you not want to load into these positions on these downdrafts? Why would you not want to do that? If you understand this vested interest theory, these big guys are going to make sure that NVIDIA is okay one with the other. And guess what happened? Deals were made. NVIDIA was exempted within certain rules or whatnot. And this whole latest thing about chips, tariffs, as long as you make them in the United States or you promise to spend money in the United States, you get a pass. I don't understand how all of that works or why it was done that way. That's not, the nuts and bolts of it. I really don't care about that. What concerns me is that a deal will get made. Something will happen that will make sure that this stock is going to be fine. I believe the same thing with a Microsoft, the same thing. And it's kind of like what they say, safety in large numbers. Okay, safety in large numbers. Now, I can't guarantee that the theory is going to work every single time. But when we go in and we look at our analysis and we see who's buying NVIDIA, who's selling NVIDIA, how much are they buying, we look at the top funds in the world, the top hedge funds and the top institutional funds. Like, what are they doing with these positions? Are they trimming them? Are they loading up? And to me, when they're loading up, I'm like, okay, why are they loading up? Well, apparently they know something, or else they wouldn't be doing it. They have the fundamentals, they have the technical analysis, they have all the data that they need to make the right choices here and either buy or sell a position. And, if they're analysts are on TV saying, hey, this is not a good idea. People are on TV saying, hey, you want to get out of here, you want to sell here. And I go in there and I'm looking to see these guys, these top institutions buying these funds up or buying these stocks up. I'm like, yo, something's going on here. I want in on this too. And so from there, we do an options overlay on the stock, and it can be a long dated option, which gives it time to, run up. If it goes down 30%, it can be up 2,000%. Who knows? But we give these options time. But I do believe in concentration risk, but I also believe in heavily concentrating concentrating a portfolio at a certain particular time in history due to certain things that I think are just overblown, especially with the CNN Fear and Greed Index. I use this thing all the time. And so what I wanted to share with you today is, yes, I got a great outline over here about concentration risk from AI. But if I trade my clients based on what AI says, am I going to make them any real money? Am I going to be able to take advantage of every single opportunity in the market? No, because I'm going to be persuaded, okay, that this information is correct. I should follow this, I should follow this, I should do that. They say do this, do that. And if you're trained a certain kind of way, then it's hard to go in and undo like your beliefs. Like some people have beliefs about paying fees. I believe you never should pay no more than a certain percent and blah, blah, blah. But yeah, but what are you giving up? It's called opportunity cost. What are your lost opportunity costs by just sitting in the Vanguard fund? Now, here's the thing. If you're that type of person where you don't like dealing with nobody, like you don't want to deal with others, you just want to do your own thing and just live your life and not be concerned and just, diversify like that. And say you got $1 million and you put it over there and you get 13% this year, that's $130,000. I mean, you can live with that and you can sleep at night. You don't have to worry about, is your advisor working hard? Is he doing his job? And, are you beating them? But yet you're having to pay them all these fees, but yet the Vanguard is 0.5% of whatever it is. And you're still getting an okay return versus them. You're paying them 2 and 3% or whatever it is. And they're only getting half of what the Vanguard fund could have done. These are all legitimate questions. And trust me, you have every right to ask those questions because it's your money. But understanding how to take advantage of moments of time where it's like the Brinks truck moment where all the money is in the street and you can go get as much as you want without going to jail. That's what we do in our portfolios. It has to be done at the right time. And when it's time to retire Michael Jordan, guess what we're doing? We're taking those profits and we're buying mutual funds, or we're buying gold funds, or we're buying money market funds, or we're just sitting the money in cash. And I'm going to talk in my next episode about, some of the worst periods of returns in the market, like seasonally, the worst time to invest and the best time to invest. I'm going to get into that in one of my next shows, maybe the next one, who knows. But I just wanted to share this with you guys today. So I don't think humans are going to lose out completely to AI. I think we have a leg up on the psychological aspect, because if you give your portfolio to an AI bot and say, hey, go manage my portfolio based on all the stuff they program into that machine, I guarantee you when the algorithms kick in on Wall Street and they start selling everything, your bot is probably going to follow along and say, hey, I got to sell everything because the algo said it's time to sell. Let's all get out of here. And Warren Buffett said, sell high, buy low. And if they can teach that to the AI bots, you'll probably have a pretty good trader. But if they don't programming this stuff in, man, I tell you, you can miss out on some phenomenal returns if you don't take advantage of these opportunities. And so that's all I wanted to share with you folks today. And so until next time, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.